Whoa, boy, rates have dropped off the edge of the table. Hey, just wanted to reach out to you. All the predictions that we've been looking at for the last year and I've been posting about are all happening. Um, the stock market did drop and hit the 200-day moving average. We were talking about the 10-year Treasury. Let's look at that real quick. Hitting, the 110 level. Everybody's no way, no way, no way. This is back in this area here, which was really, really low. You can see where we were on Friday, the 28th. Okay, right at 110. So that's awesome. I will say this: we're going to have probably some more outbreaks of the coronavirus. That's causing a problem in the stock market, obviously, but it's not solely the reason for the drop in rates and the stock market reaction. Hidden behind those things are things that we've been talking about for about a year. The inverted yield curve happened for a while, and actually just a couple weeks ago, the 3-month Treasury actually was inverted for a while too. So just recently, we've got a slowdown in global trade. There's a slowdown in manufacturing. We talked about that. We track the rates across the country in manufacturing. Slowdown in shipments. That's one of the big signs that are an indicator of a recession, which we've been talking about for a year as well. We track the train, rail system, Federal Express, different companies that do actually deliveries of goods, and that's slowing down a lot actually. We talked about the potential recession. Prediction was end of this year, next year, but we've got a huge amount of debt we're hanging on to, and stock market's at pricey levels. We've been talking about that for a while too, and soon the Fed's going to stop buying treasuries. That's what actually steepened the yield curve. When it was inverted, they started buying 80 billion with a B dollars of 1-year notes, bills, actually 1-year bills, to help the short end of the market and steepen the yield curve. It's artificial. That's that as a temporary fix. I think they're probably going to stop doing that probably in March or April. That's going to further cause things to get good for mortgage rates, maybe not so good for a stock market. Low inflation. We've got all of those things all lined up. So yeah, the catalyst was the coronavirus. Help accelerate the process and bring it forward. So instead of the end of this year, next year, we seeing all-time low rates, which we've been predicting for quite some time, we are seeing that now. We are literally at all-time lows. So if you are refinancing or buying, now is the time. Don't wait till somebody else tells you that we might be at the lows. We're there, and you don't have to lock your interest rate today. You can wait a little bit, see if we see a little more improvement, which I think is likely actually. But you can't wait till we've already hit the bottom and things correct the other way, and you lose the advantage of having really the lowest rates out there. I mean, I really think rates will go lower. Obviously, stock market has had several 1,000-point days. Yesterday was down 1,000, but it closed at 357 down. So it did make a little bit of recovery. Personal spending's way higher than expected still coming out, and so that's a great thing. Inflation is low, but I think the Fed, as they always do, they make mistakes. I don't know how some of these people get in the position they're in as a Fed governor, but they watch what's called the PCE, the personal consumption expenditures, and that leaves out things like rent and medical expenses, things to keep a house over roof over your head. I don't know why they watch that number, but that number's at 1.7. It went from 1.6 to 1.7. I watch, and I think a better indicator, as I've said many times before, is the Consumer Price Index, which is running much hotter at 2.5% on the headline number and 2.3% on the core, 2% being the target. So we're over the target. I do see continued market turbulence. based on the latest news regarding the coronavirus, and especially if we see more spreading. But so let's take a quick look at the market itself. Um, we were looking last week, actually probably starting right around here, the 10th. We started to see signs of what's called a cup and handle, and that's a sign, a good sign actually, that things are going to improve. And this is the cup right here, and then on the 25th, just 4 days ago, we started to see the handle formation. So you see a cup and a handle. Right now, I mean, this is, through the stratosphere. These are levels we haven't seen in, boy, forever. Let's go back and look. This is a 2-year window. Let's go all the way out as far as we can on a longer time frame. And let's max it out. Doesn't matter how far we go. I'll tell you, we haven't been here in a convincing place. We were there touching it back in July 8th of 2016 for other reasons, not directly market driven, and with no, obviously, as it fell off, these are mortgage-backed securities. So as the securities drop, rates go up, and obviously the opposite happens. As we are at the bottom and the mortgage-backed securities go up in price, rates drop. We are here right now. That's at or very close to the all-time low. We're doing conforming loans right now, 30-year fixed, below 510 at 3.125. VA loans are being done at 2.75. So if you have a VA loan that's above 3.5, we can go ahead and get that wrapped up to 2.75. No appraisal, no income, no assets. Basically, just very minimalistic documentation, and it's a slam dunk, and they happen very quick. Doing some of those in 15 days from start to finish. But even if you have conventional, that's just awesome. On the high balance loans between 510 and 765, we're sitting right around 3.5-ish, which is crazy. So if you're looking at rates on a high balance loan above 4%, you need to be refinancing now, or at least get application in and be prepared to lock it. I do think we have a little more downward pressure on rates, so I think we're going to be now or sometime very soon in a position where everybody should be pulling the trigger. So let's go back to the quarter again. Let's look at the treasuries. That's actually just, a shocking thing to look at. We have right around here, back in the early part of February, end of January, there's a little bit of turbulence here, but we have a obvious downward trend, and as you can see, Friday we penetrated the trend line noticeably, very strongly. I think we're going to have some follow through. We are at all-time lows on the 10-year treasuries, and I think we're going to go lower. Usually, bonds will follow, and mortgage rates, which are mortgage-backed securities in the bond market. Because one of the things we're starting to see now is what's called convexity buying. And so convexity buying, what that is bond managers will look at having instruments for long-term, a certain duration in their portfolio. And then as rates start dropping and people refinance those, all of a sudden the durations get shortened tremendously. And so now they've got to find a place to get a yield and to park the money. And typically they throw it over in the treasury market, which is what we're looking at right here. And so as treasuries fall, typically mortgage-backed securities fall, and then rates drop, and then more people refinance, and then people take that money and put it back into the treasuries. So it's a cycle, and we're into a big, as you can see, a tremendous drop off here, and rates are the same way on the other side of the bond market. As you can see right here, let's get rid of these treasuries here. As you can see right here, this is crazy. These are typically, you're never looking straight up or straight down on any kind of movement, but we're seeing pretty much straight up right now. we will be at the all-time low, or actually, I believe, lower than the all-time low, which we're right about at now. I would not be shocked at all to see rates in the high twos. So take my advice. If you've been following me for the last year, all the predictions are coming true. Everything's lining up. It's happened a little sooner because of this outbreak of the coronavirus. That's helped accelerate things. But it's all lining up. It's all happening right now. You need to be in a position to pull the trigger and lock in an interest rate, buying a home or refinancing. So give me a call if you're interested in doing that. We're doing a lot of business right now. We have plenty of room for new business. Give me a call at 703-598-4198. Make sure you're following us on Homestead Mortgage LC on Facebook to see updates like this video. And hope to talk to you soon. And be prepared. Rates are going to continue to drop, and you're going to be shocked at interest rates that are going to be available very soon. Talk to you soon. Have a great day. Bill Burnett.